Okay, so we're going to assume that you're a first-time home buyer, and there are a lot of options out there as far as loans are concerned. So let's talk about those. First off, they affect each other. So if you were doing an FHA loan, let's talk about what that means to you, and then I'll talk about whenever we're searching for houses, what that means to us. So FHA, let's break that one down.
FHA. FHA has some different guidelines compared to some of your other properties. Off the start, I want to let people know that an FHA does not mean you have to be a first-time home buyer. In the mortgage terms, we just make sure that you have not owned a home in the last 3 years. So anyone who hasn't owned a home in the last 3 years can be considered to be a first-time home buyer again. There are some different requirements with the FHA compared to some conventional VAs, where there are a little bit more lenient with credit scores, we're a little more lenient with debt to incomes, we're a little more lenient with bankruptcies, that type of stuff. FHA has a couple different programs where you can get into a home with no down payment, but the factors that come into play with an FHA that always kind of helps is the down payment. You don't have to have as much in the bank account to buy a home. We will still require the same DTIs of 45%, but somebody who comes in with a 620, 640 credit score, we have that option to get them qualified, where on a conventional, we're going to probably like to see a 660, 680 to qualify. Now, there are some guidelines where they're not as beneficial with an FHA in regards to PMI. The PMI, which is your private mortgage insurance, is going to stay on for the life of the loan, where a conventional VA, they don't.
Now that you've mentioned it, explain what PMI means.
Your PMI is a secondary insurance that lenders, bankers keep on their loans to make sure that if the house were to foreclose on, we're going to get some of that back. We have to have somebody who's going to insure our loan to make sure that we're going to be taken care of if the loan were to go in default. If we go back out there and sell that property, we need to make sure we're going to be able to consume back over some of the income that we lost.
And those private insurers are typically like your Fannie Mae's, your Freddie Mac's.
In your FHA, those rates are already set. For first-time home buyers, the 0.85 with the minimum down at 3.5, and it goes down to 0.80. Now those are off of your sales contract or your purchase price of the home.
Okay, so what FHA means to us whenever we're showing you houses: number one, cannot have peeling paint, so foundation issues, sidewalks that tilt towards the house, missing floor covering, things along those lines that the appraiser is going to come in and say, well, no, this doesn't align with what your mortgage is. Now, if the homeowner has some equity or has some cash and they accept that loan, then we're going to negotiate to say, listen, you got to fix this because you've got to bring it up to appraisal guidelines. So sellers that we work with know that that's going to happen. That isn't always the case, but whenever we write an offer, we typically will say, listen, we know that these things aren't going to fly whenever the appraiser shows up, and the lender can't give you the money unless the appraiser says it's okay. So FHA and VA are very similar when it comes to the guidelines. There are written guidelines that say this house won't work. So you always have to remember that just because you can afford, say, $65,000 doesn't mean we're going to find a house at $65,000 that's going to meet those guidelines. So sellers either got to be cash tight and can help take care of it, or you're going to end up having to negotiate to take care of it. And we want to keep you in the best stance possible, which is to look at the right houses, the houses that you're not going to have additional work along those lines. There are also 203K loans. Explain those a little bit.
We actually
nobody loves them. I'm just going to say that.
Yeah, we don't actually do any 203K loans. Your lender has to be registered or licensed to do so. I'm not familiar with anybody that is registered or licensed in Topeka at this point. It's just they're a little bit more difficult to do. They're a little bit longer term loans. They usually will take from personal experience 90 to 180 days to close. Contractors have to be licensed, and usually the bank or the lender will have to choose who's doing the contracting.
Right, so you can't sign up and say, oh, well, I know how to do all this work, just give me the money. They have to be licensed contractors, and they can't be your cousin Bob. So you have to really understand what you're getting yourself into. Join us again next week on Monday. We'll have more in